Well, markets are basically closed at this point, and mortgage rates didn't move a lick. Why? Well, the markets in general, interest rates and stock market is basically holding steady right now for what? S&P's little change as traders look ahead at the jobs report that's coming in tomorrow. So tomorrow we have a couple of reports coming in: average hourly earnings, non-farm payroll, and the unemployment rate's going to be posted. So I thought this was a perfect segue into this article right here. This was just there's an interview this morning or this afternoon with Starwood's Capital, Barry Steinlich. You got to watch this video because it's pretty in-depth. And when he's done, I'll put a little bit of it in the context for you, but I think you'll get the gist of it. Watch this video. It's intriguing. And I learned a lot today as well. So without further ado,
on the economy. Let's break this down.
Well, the economy is obviously stronger than people thought. And I think I want to just talk about the structure of the economy because this is not my parents' economy, and it's not built that way. And that's why Powell's is having such a hard time changing it. If you look at the employment market today and the year-to-date, what's happened in the employment market, there, 50 million jobs are in healthcare, government, and education. Mm-hmm. And you see that's the biggest bar chart on that page. And the third category of almost 100,000 jobs added this year is construction. You're not supposed to see that, right? You're not supposed to see that with a 500 basis point increase in rates. And these drops that I mentioned in multifamily and office and logistics dropping 70%. So his rates are not impacting this job market, and he's not getting the layoffs. Go to the next.
But can I just say very quickly, if he wasn't doing what he was doing, Jay Powell hadn't raised rates to this extent, where do you think inflation would be? Because all of this spending that was already baked in.
I believe it would have gone down on its own.
Okay, why?
That's because the money was being worn out, and it was driven by a lack of supply on the shelves. I don't think he needed to do this. Maybe 300 basis points,
but
not
he's
500.
He's also battling a lot of fiscal spending.
Well, if you bring up the next slide, you'll see that what's happened since he started raising rates in the healthcare industry, which is completely insensitive to interest rates, you've added 3.2 million jobs in healthcare since May of 22. So he's had zero impact. 3.2 million positive jobs since May of 22 in healthcare. So obviously that's like, and you still have a nursing shortage. You're going to have more inflation, more people looking for jobs. The report this morning, the ADP report, showed there was another second category. Go to the next slide. This is the one that's completely shocking, which is construction. And this is where spending comes in.
Right.
It looks just like healthcare. We've added 1 million jobs in construction. You lost 1 million jobs in 07, 08 in construction. We've added them, even though he's increased interest rates 500 basis points. Why? Data centers, the transportation bill, the CHIPS Act, the infrastructure bill. So he's not getting layoffs in the part of the market that are most sensitive. This is the...
He just mentioned some items there that came to, I think, over $1 trillion when it came to well, they called it the Inflation Reduction Act and then the CHIPS bill and all that other stuff. That's what he's talking about here. The government's going nuts right now, just pumping out money, and they don't realize it. It's like grandpa keeps giving out money and then eventually realizes grandpa's got no money left. And that's what we're seeing right now in our economy. So my apologies for the interruption.
The most sensitive employment category to interest rates, and it's going the wrong way. So his toolbox is not working. And
basically, he can't do it. It doesn't matter what he does.
He can't do it. Or he has to go after services, which is retail, lodging, hospitality, business trade. If he hits that, he creates a great recession. If he's going to knock those jobs out, which is a big category, he's going to have a serious consumer recession, which I don't think he can stop. And that's when he's going to have to get aggressive on rate cuts. So and the consequence of this is not small. The consequence is the federal government, and I think that was the last thing I had, is the biggest victim because Rick Reeder is a guest of you all the time, right? He'll argue that high rates are creating inflation from BlackRock, right? He thinks that the excess, we're making $235 billion of excess interest income today. It used to be 70 billion consumers got when T-bills were low. Now it's 318 billion. 235 billion of excess interest income is going out and buying things like services. He'd argue that the show used to be $100 and now it's $300, right? Goods are going down, services are going up because consumers have excess cash from the savings they're getting, the interest income they're getting from all the cash they have in T-bills. So he's arguing that high interest rates are creating more inflation. So I think it's pretty...
This is where I said, and I'm not trying to be disrespectful, if you have money right now, you're making more money because the stock market's doing very well. Cryptocurrencies are doing very well. Savings accounts, think 3 years ago, your savings account, you earned maybe 0.125. Now you're getting, in some money markets and so forth, 5.5% interest rates. So if you have money right now, you're doing okay because that money's compounded. That's exactly what he's saying. Now, this guy isn't any just amateur. He's a bigwig on Wall Street. So, a lot of you guys are going to put comments down below. This guy's an idiot or whatever. This guy knows what he's talking about, folks. Fortunately, unfortunately.
Pretty interesting to see. And the government will spend, as you know, interest expense just past defense spending.
Right.
And it's on its way a third of our debt. So he can spend 4% on 13 trillion or 5% on 13 trillion. That's the interest expense on the amount of the debt rolling just this year. Half of our debt will roll in the next 3 years. So that's number one. The federal government is the biggest victim of his own problems.
Here's my argument with Powell is that he can only do so many things. He has two mandates. One is the inflation rate, the other is unemployment. Those are the two things he's supposed to be watching. You're right that he has a limited toolbox in what he can do.
Very limited.
I don't know that this is a fault of Jay Powell and the Fed, or if this is just there's only so much they can do, and there are all these other forces that are adding up.
It's a tough job, and with Congress spending money the way they are,
that would be my.
It's not, again, one arm of the government has their foot on the accelerator, and the other on the brake, and usually things explode when that happens. The engine wears out. I hope it doesn't explode. I mean, the U.S. economy is being powered with productivity. A lot of jobs are part-time; they're not full-time. But I think he just has to be careful, and I think because of the housing market with 4 or 5 million home deficit. And that is the biggest component of CPI, this deficit that he's making ever bigger because housing starts are falling and we're not building as many units will show up in a couple of years with higher rent growth than he ought to have. He ought to smooth it out, lower rates, increase construction. But, it's a tough thing. And then you have the regional banks. And don't forget,
So that's what he's talking about. He's saying, we have a housing shortage now. You guys are experiencing that if you're out there trying to look for a house. But think if you're renting. Now you have people buying houses and you still have a shortage. Now, a lot of people are still saying, okay, we don't have a housing shortage. I can't go over, you can't just make up stuff that I can, debate it. So this is what he's saying. He said, if we don't cure some of these things, the debt that's rolling over is being refinanced at a much higher rate. So that's causing the interest that we pay as a country to be much, much higher. And then he's saying also it's curtailing a lot of housing, people building homes. So this is going to starting to affect rents again. So rents basically skyrocketed during COVID, and then they're easing off right now, and now they're going to heat up eventually. So it's kind of a perfect segue into this section right through here is housing. What are the pieces of the puzzle that go into inflation? One of those is in representative of housing. Let me get this out of the way real quick. Lumber prices are down year over year. So you have big components like lumber and oil. Let's look at those charts real quick. Here's the lumber chart over the year to date. So year to date, here's where lumber has gone, okay, in regards to price wise. Let's get over to, let's say, 1 year chart. Okay, lumber was up to $609. I'll say a bundle. What's it at now? It's at $493. But let's go back just a little farther. This is what's going to blow your mind right through here. We had $1,600. I'll say a bundle. I don't know how they evaluate these things. So 1,670. When was that? In 2021. Now what is it today? 400, 500. Okay, so it is substantially down. You go over to oil. Here's where oil is so far year to date. Okay, let's go over a 1 year chart. You're going to see it's down right back through here. Back in September of 2023, we're at 93. Where are we right now? I think it's about 80 or 72. So my question here is, why is gas still in Chicago still $5 a gallon? Because that's what it was back here. Remember when gas in 2022 and 2021 hit like $5-6 a gallon? Well, oil was at $120 a barrel a year ago from now. What's it at now? Okay, 74. So almost half. So shouldn't gas prices be almost half of when they were, peaked out at $5.50 or $6 a gallon? just a thought. So a lot of these things are going to roll over. So that brings us to where we are today. And bond markets are completely just stabilized. We're pretty much closed for the day. So bonds ended up down 6 points, and you see the mortgage rates have not clicked a bit. So tomorrow's news that's coming in, we're going to have those employment numbers. They will affect the market, even though there's this video was fantastic. The interview that we saw, these numbers are still going to have a huge impact on what happens tomorrow in the markets, especially the housing market. So thanks for watching, guys. God bless. Have a fantastic evening, and I'll see you here again